Passively managed assets have grown dramatically since the inception of index investing in the 1970s. Since then, some questions have been raised regarding the impact of continued growth in indexing. Hello, I'm Tim Edwards and I'm joined today by my colleague Craig Lazara to discuss the findings of his recent paper, The Slings and Arrows of Passive Fortune. Welcome, Craig.
Thank you.
So there are a few questions you and your colleague Anu Ganti addressed in this paper, are really sort of myths or things that you hear about index investing which maybe could be corrected.
Exactly.
They fall into sort of different categories, but just to start with at the top, some of the concerns or questions that have been raised essentially connect to the fact that there are a few large providers of index funds and they nowadays own quite a significant proportion of the market.
Exactly. And so what we hear from the critics of indexing is that the big three, so-called BlackRock, State Street, Vanguard, because they own maybe 20 to 25% of every large company in the U.S. and increasingly outside the U.S., that they don't exercise adequate stewardship or governance with respect to those companies. And the argument we made in the paper is that, contrary to that charge, all three of the big three are increasingly becoming involved with corporate managements. They've all staffed up in their what generally is called governance units. They're being more engaged with management, and finally, they would argue, as we would echo, that because they are permanent owners of funds, in other words, as long as a company is in the S&P 500, everybody running an S&P 500 index fund will own the company. Because they're permanent capital, they have a greater incentive to be involved with management and engage with management rather than a lesser incentive. And we've seen that in their behavior as well as in the logic of the economics.
Perhaps the most common criticism of index funds that I've heard, and sometimes it's not even couched as a criticism, it's just general market commentary, is this idea that somehow flows into passive funds or the existence of passive funds is distorting the overall market. It's creating a bubble.
Right.
Really, the idea is, particularly in US equities, there's a big bubble in that market caused by passive funds.
Exactly. And that argument occurs on two levels. There's sort of the general level of indexing makes equities overvalued, and then there's the more specific argument that says the larger companies in an index become overvalued because they get a disproportionate share of index flows. And we think neither of those is a valid argument, in part because what you see there, as is often the case in these kinds of discussions, is that the critics of indexing are seizing on a facet of market behavior, which applies to all investors or investment generally, and they're attributing it solely to index funds. So for example, when they argue that generally the market becomes overvalued because of flows into index funds, what they're really saying is when investors sell stocks or commodities or property and put the money in equities, equity prices rise. Well, that's certainly true, but it would be true whether the money went into indexed equities or into actively managed equities. So although it may be true that a general preference for investors to own equities has increased equity prices, it can't be true that a general preference for index funds has been the reason why that's happened. Because after all, as you know well, the aggregate of all active managers own basically the same allocation of each stock as do passive funds. So that's the general argument. The specific argument, as I mentioned, relates to the larger companies in every index, and so the critics will say, well, you know, Apple and Microsoft and Google and so forth get to be more and more overvalued because as money comes into the S&P 500, it's disproportionately invested in them. And again, we think this is completely untrue, and I'll try to illustrate that by example. Think of Apple, it's the largest company in the S&P 500, approximately 4% of the S&P 500's overall overall capitalization. So imagine $1 billion buy program hits the floor this morning, and somebody wants to put $1 billion into the S&P 500. $40 million is earmarked for Apple. Apple was 4% of the S&P 500 last night. Apple is 4% of the amount that the program is going to buy, and Apple is going to be 4% of the S&P 500 after it's all over. So there's no distortion in relative valuation by money flowing into the S&P 500. Now, that does not say that Apple can't be overvalued. Apple may very well be overvalued. But if it is, it's because people are buying Apple, not because people are buying the S&P 500. And that's the point that the critics miss.
I guess, and then that relates into, so Apple being over or undervalued if it gets corrected, it'll be corrected by active managers.
Exactly.
So one of the related criticisms is the growth of passive investing has hurt price efficiency. The idea that no one is not enough people are helping to set efficient prices.
Right, and that's I think the most, if it were true, the most damaging charge that people make about indexing, and we're not terribly concerned about it for a couple reasons. One is that the argument relies in essence on the view that what you need to set prices efficiently is active managers trading. It's by trading that prices get set, not by ownership. Trading is what matters. So what we did in the paper is to try to imagine what the relationship between the market share of passive assets is and the market share of passive trading, making some fairly conservative assumptions. As we all know, passive funds turn over much less frequently than active funds, and what we assumed was that passive turnover was 10% and active was 50%, which is probably conservative on both sides. And what we were able to do then is to show what the relationship between trading and assets under management looks like. And as our viewers can see on the graph that we're showing here, as passive market share grows, the passive share of trading grows, but not at a proportionate rate. So for example, if passive funds own 20% of the assets in a market, roughly 5% of the trading would be passive, 95% is still active. On our assumptions, which as I say are quite conservative, you have to get index market share up to something like 83% before index share of trading gets to be above 50. So although it's true that you need active managers to make prices efficient, we have a very long runway in front of us when there'll still be plenty of active trading. Now, a good illustration of this, or the fallacy of this argument, can be found in the S&P 500. There, as you know, all stocks in the S&P 500 are weighted by what we call float capital. So only the shares that are actually available to the public, to investors to be purchased. The biggest unavailable block in the S&P 500 by far is from Walmart, the big retailer, and roughly 50% of the total shares outstanding of Walmart are not in the S&P 500 because they're controlled by family trust. The Walton family, founding family, owns still roughly half the stock, not in the 500. The Walton trusts are basically a one-stock index fund. They own the stock, they don't trade it, they collect their dividends, they vote their proxies, like an index fund would do. So half the capitalization of Walmart is permanently off the market. No one's ever argued that Walmart is not efficiently priced because so much of the stock doesn't trade actively. And that's the analogy we wanted to lead with, to say that you don't need as much active trading as you now have for prices to be efficient.
Just as a final point, just to make it clear, you're not really saying that we don't need active managers.
You clearly need active managers. It's active managers or factor-based index trading. For example, a value-oriented factor index will buy stocks because they're cheap, in the same way that a value-oriented active manager will buy stocks because they're cheap. So with that exception, you definitely need active managers to do trading. You just don't need as many as you now have.
Craig, thank you very much for joining us.
Thank you.
To learn more about the topics discussed today and to read our recent research and commentary, including the paper, The Slings and Arrows of Passive Fortune, please visit us at spdji.com. Thank you.